All right, we're back. Tasty Crypto Show. I'm Ryan Grace. With me today, of course, Katie McGarrigle, the wizard,
the Jedi,
the assassin.
Yeah.
How you doing, Katie?
Well, I'm a little disappointed. I tried to hype up the chat and they left me on red. Come on, guys.
WTF, chat.
What's that about?
Shout out to the chat. If you were not streaming this on YouTube, I'll get your ass over to YouTube and type some crazy shit into the chat. That's what it's all about. We do have Edward, Grumpy Mike, Donaski. What's up? Yeah, there you go. Thank you, Edward. We're fresh off of the show in DC. A lot going on down there.
Yeah, for real.
Tasty Live was there last Thursday.
Yeah, it was a great time. I had never been there. We had some great food. I got to spend a lot of time with you. We talked quite a bit about what is happening both in what I would call the regular crypto world versus some more fun endeavors that are kind of popping off in the crypto and DeFi universe.
Yeah, like collecting rocks.
Yeah.
The rewards for the rock pool are no longer, unfortunately.
No, are you kidding me?
So rock
I missed
mining.
the boat?
Yeah, maybe for now. Maybe it'll come back.
What in tarnation?
But that said, yeah, we were talking Bitcoin in a portfolio. You guys being yourself, Mike, Nick, all talking options trading, of course. And then I wrapped up the show with a little BTC in your portfolio.
Yeah, I would. And I'm so excited that you're actually kind of bringing this to the show today because, you know, it's still the most common thing we get from everybody that's been a longtime viewer here is like, I just don't know. You haven't made it compelling enough for me to do it, essentially. So I'm excited for you to kind of impart your little nuggets of wisdom that you have. You have more than
there's
nuggets.
no Bitcoin in your portfolio, Katie?
Oh, I have Bitcoin in my portfolio.
You're just saying this is what the streets are saying.
This is what the streets are saying.
Okay.
Yeah, you've converted me.
Got it.
I'm a grasshopper, but I'm a convert. So today it's all about converting the rest of the people that are watching into putting this into their portfolio. And I think you've got some very powerful justifications for doing so.
Yeah. I will not be able to, unfortunately. Fortunately, I'm having a child. My wife and I are having a kid towards the end of the summer, early fall. Due date is in September, beginning of the month. So I'm not going to be able to join all of the other awesome events that are scheduled. Won't be able to go on the road. So we're going to do the performance in some capacity. We're going to give the presentation more realistically here on the show and talk about what we covered on Thursday night, or a chunk of it at least, and that's Bitcoin in the portfolio, looking at this objectively. I think we've told a story previously here on the show about why it's a compelling investment. Mm-hmm. Today we're going to look at its returns, and we're going to look at the impact it does have, or at least has had historically, on a portfolio, depending on the allocation that you might make.
Love it. It's fired off.
And scramble everything. I do not have any position in SBET for the ETH treasury, but I do own some ETH, so I've got my own treasury. Long ETH either way.
Okay. Yes. But yeah, SBET was down, like 75% in like a day or two?
I didn't see
crazy like that.
Okay.
That's what I saw.
A little discount, maybe.
Yeah, maybe. Or somebody knows something.
Somebody always knows something.
Always.
All right, let's jump into this. Bitcoin in your portfolio, a little portfolio power up, if you will. To get started, Katie, these are the exact slides from the presentation. So if you weren't there, you're here now.
Yeah.
How has Bitcoin performed? How has BTC performed in a portfolio or over time? So objectively speaking, this has gone through a series of booms and busts. It's very volatile, or it has been at times. And so we look at the last 10 years, the average annual return, 84% for this asset. Last 5 years, 65%. 2024, total return, it was up 120%. And in the last year, on a rolling basis, it's probably a little bit higher now, given the price of Bitcoin is 108, and we were probably about 104 when we did the show. But it's up 56% year to date.
Pretty dang compelling so far.
Excuse me, not year to date, 1 year.
1 year.
Yeah, 1 year.
Yeah.
Actually, it's up 64% 1 year right now.
There we go.
But here's the thing, as everybody knows, this performance and outperformance relative to everything else at the time is not without serious bouts of volatility. So you have to be able to stomach some pretty large downside moves if you're going to hold this throughout these cycles. 2014, we had a drawdown about 59%, depending on how you measure it. Might have been a little bit more, give or take. You look at the intraday move or the daily move versus the weekly or monthly return at the time. It could have been a little bit worse, but down about 60%, 2014, 2018. You have the ICO boom and then subsequent bust, 27 to 2018. First time that Bitcoin really popped up on everybody's radar. It then had a drawdown it was closer to 80% towards the low, but on a monthly basis, about 73%. In 2022, FTX, we all know what happened next, down about 64%.
Where's time going? I can't believe that was 2022.
Right?
It doesn't make sense.
We're still talking about it. And maybe in some ways still kind of feeling some repercussions, or at least we were in the industry in terms of how it was approached by regulators. But yeah, down 64% after that. So we've survived some real serious bouts of volatility here. And I think, you weather the storm, you kind of grow accustomed to this, and you do have the returns on the other side of it that make it worth it at the end of the day.
Right.
But we can't shy away from the fact that when you do have an asset like this in your portfolio, historically, it's had some pretty serious bouts of volatility.
Sure. But you can also consider that we've also seen bouts of volatility just in general in the markets as a whole. I mean, yeah, sure, we had 2020 ended up being like a great year, but like if you just look at that March, April chunk of time, it was pretty damn bad. And if you consider the fact that like if you were only in an equity exposed portfolio at that time, you were experiencing probably similar, if not worse, drawdowns in a lot of ways.
Yeah, absolutely. At least at that point in time,
Totally.
You had some serious fall. And I think when you look at this, it does have, considering it's a commodity, or maybe some people consider it a currency, I look at this much more as a commodity. I think that while it is a cryptocurrency, it's a commodity or has commodity-like characteristics, right? This is similar to boom-bust cycles you might see in energy markets, for example. We have years where oil goes up a lot, and then you have corrections in the oil market that last for months, if not a year or more at a time, where you can draw down 60%.
Yeah.
We've seen that historically as well. So it has, again, commodity-like characteristics in your portfolio. But if we just visualize that performance over really the last 10 years or so, going back to 2015, this chart is skewed by that 2017 performance or significant outperformance, up over 1,000%. And then the crash in 2018, drawdown again in 2022. But generally speaking, it's gone up.
Yeah.
Hopefully it continues to. Doesn't mean that it will, but we're near an all-time high here today. So it's been a pretty decent investment over a longer time frame if you can stomach the volatility, I think is the point.
All right.
Well, does it fit in your portfolio, Katie, is the question we're going to try to answer here today. So I think we'll find that there's an argument for including Bitcoin in a traditional 60-40 portfolio, given the resulting performance gain and the subsequent impact on volatility. And that's what's important here. We know it's volatile. We know there's a lot of risk associated with this. But are the returns worth it? And historically, I think we'll find that they are. It's also largely uncorrelated to equities and bonds in that 60-40 portfolio. For anybody that's not familiar, 60% equities, 40% fixed income in terms of that traditional makeup. I don't think anybody really adheres to that, though.
I don't think so. I think we've done also a lot of bit of research on how we kind of approach structuring a portfolio as well, where there's a little bit more, mostly more by like trading vehicle necessarily than by exact products or asset classes you need to utilize. But yeah, I don't know many people that do. I don't know anybody that does, honestly.
No. So this is more of just a benchmark, or the way that we've structured this to obviously kind of objectively look at the research. But when we did this or put these numbers together, included a portfolio of $100,000 and allocated 60% of it to the SPY, 40% of it to TLT, give you that long bond, U.S. Treasury bond exposure. And we looked at this over the last 5 years. Had to pick a window. Bitcoin hasn't been around that long. I think if you go beyond that, it just skews it way too much, because you have a year and you have other periods of time where Bitcoin's up 1,000%, 500%. So it's maybe unfair. But looking at the last 5 years, you still have had decent returns, across the board for assets here. But when you look at that traditional portfolio, you've got about a 14% volatility. That's annualized. And I think that's kind of in line with what we see with an average VIX for the most part.
Sure.
Add a little bit of Bitcoin, 5% allocation, you jump, of course, 17%, 10%, 20%. And the more Bitcoin you have, the more the portfolio clearly reflects Bitcoin volatility. So you put 20% of your portfolio in Bitcoin and you're going to see the volatility versus a traditional 60-40 makeup just about double.
Okay.
So that's the impact on portfolio volatility, but let's look at the returns here. And so here's the 5-year portfolio growth with those Bitcoin allocations, just using an arbitrary 100,000. You could do this with 1,000, 10,000, whatever. We'll just say $100,000 portfolio. And again, you've done pretty well over time being long assets.
For sure.
I think there's a case for owning stocks, bonds, forestry, I don't know, hard assets, gold, real estate, Bitcoin, you name it. The debasement of fiat currency tends to result in asset price inflation. I would argue that's ongoing. And certainly over the last few years, you've done well versus just holding dollars. It's not like you lost money.
Right.
Put it that way.
Yeah, for sure.
So we have the traditional portfolio here in green, which just eyeing this up gives you a return of, let's say, about 50%.
Yep.
You add a bunch of Bitcoin and you go up a lot more. And so here is the performance just for comparing these different allocations versus the traditional makeup, 5%, 10%, and then that 20% in orange there. But when we look at the drawdowns, certainly, again, you would have some pretty serious losses on paper, at least, if you put a bunch of your money into this asset and you experience some of these drawdowns that we saw.
Yeah. And then you didn't, cover them along the way or close some of that risk off along the way.
Exactly.
This is assuming that you are just holding everything into perpetuity.
And so with the traditional portfolio over the last 5 years, you did have a drawdown of about 26.5%. Now that came from, at one point, we saw a lot of volatility in the market and we saw a ton of volatility in the bond market. That's the other thing to call out is you have this risk-free rate and you have treasury bonds that don't typically experience a lot of volatility. But during that period where the Federal Reserve hiked interest rates at really the fastest on record, you had pretty serious volatility in the bond market. So that thing that is supposedly the real safe asset that isn't all that volatile had historically extremely high levels of volatility.
Right.
And so when we look at this over the last 5 years, you still experienced a huge drawdown in this traditional portfolio.
Sure.
As a result of that. But you add a little bit of Bitcoin and you get that FTX 2022 collapse and you're down a bit more certainly here, whether you have 5%, 10%, or 20% allocation, which I think makes sense to everybody. But that said, the traditional portfolio still experienced a ton of vol. So you have this big upside that you get in terms of return. You have a slight increase in volatility when you go to 5%. But there was no way to, if you think, okay, it's all of a sudden it's just adding vol to my portfolio by having Bitcoin. Not really, because again, the traditional portfolio, at least if we look at the last 5 years, had a lot of volatility in it. When we look at this as a diversifying agent, which I think is also important, you want to be aware of whether or not your returns are correlated. So we're adding Bitcoin to the portfolio, but is it just like adding more NVIDIA stock, for example?
Right.
And certainly there is a positive correlation between Bitcoin and stocks. That's in turquoise here. At the peak, we'll call it about 0.7, 0.75 back in 2022.
Right.
When
it was like 0.2.
Yeah, it's fallen a little bit. I think if you look at a longer term time horizon, you typically see about a 0.3 to 0.4 correlation. So 30 to 40% of the time, we're going to see these move in the same direction, whether it's up or down. And when we do see bouts of volatility in traditional equities, we've seen that a couple times now over the last year, and most recently in April at the beginning of the month, you do see correlations move towards one.
Yeah.
They certainly strengthen. And so you could see that here as well. That's when we got our last kind of move in terms of that higher or stronger correlation between equities and Bitcoin. But when we look at bonds and Bitcoin, really not that strong of a correlation for the most part. Sometimes a negative correlation, a little bit of a pop at times when you have volatility in the market. But I would argue there's a low correlation.
Yeah, I would say like on the show, and something that Pete taught me when I was first learning how to trade pairs was that like anything between like a negative 0.5 and a positive 0.5 is like something we wouldn't really consider all that correlated. 0.5 and above, or negative 0.5 and below, like closer to those 1 and negative 1 is, like you're saying, a lot closer. So yeah, for sure SPY, but definitely not feeling that same sentiment correlation-wise with comparing Bitcoin to TLT.
So uncorrelated for the most part. Let's look at, again, the allocation and the impact on the portfolio. And I think the takeaway for me here is that if you're looking at investing in this and you have a longer term time horizon, you can stomach some of this volatility. So you don't have a complete kind of risk aversion or aversion to Bitcoin. I would key in on kind of that 5% number arbitrarily. Is it 4%? Is it 7%? Could be around there, but that's where you seem to start to get the benefit in terms of not giving up too much with more risk,
right?
And getting that increase in your overall performance. So if we look at the 60-40, your compound annual growth rate here over the last 5 years has been about 10%, which I think is kind of what you see. Hey, you want to be long assets, whatever the historical returns are of the S&P, kind of wrapped around 10%.
Yeah.
You had some volatility, as we mentioned, with the bond market, but you're going to return about 9%. You're going to have about 14% volatility, long run average, close to what the VIX is. You have a Sharpe ratio. So this is your risk adjusted return of 0.55. Now we've seen the Sharpe ratio of the S&P kind of bounce anywhere between 0.4 and 0.8, above 1, and it's pretty good, meaning that the risk you're taking on is well worth the return that you're generating as a result.
Sure.
So you got, you're long, like I said, you want to be long assets, you're up 55% in the last 5 years, just about.
Yeah.
But you add a little bit of Bitcoin to your portfolio, Katie, and your cumulative return jumps to 99%. Your Sharpe ratio goes to almost 0.8. Your vol is going to jump a little bit, but by 3 percentage points. And your compounded annual growth rate is not quite doubling, but it's at 15%. And so certainly you're going to see those returns go up because Bitcoin has done very, very well. It doesn't mean that it will continue to. It is at near all-time highs. It had a hell of a year last year. It's off to a pretty decent start year to date. And so the more that you've had in your portfolio historically, the greater those returns have been. But you're going to start to see like some serious volatility in your portfolio, right? I add 20% Bitcoin to that 60-40 makeup, and the vol more than doubles.
Yeah.
Sharpe ratio kind of starts to top out at about 0.8 when you start adding a bit more Bitcoin, because you do get that volatility, and you still could get a lot more volatility in the future. So I think if you're looking at this as just kind of a framework for how do I think about an investment, or how much Bitcoin should I own if I have a more traditional portfolio, I'm diversified across asset classes, I look at this as a commodity exposure and I want some of it.
Yeah.
I would say 1, 2.5%, 5%, but like right around 5% is where you do have that noticeable improvement in performance with a little bit of volatility that's added.
Sure. Yeah. Is there a reason why? I mean, I think I know the answer, but like why we're talking about Bitcoin and we're not talking about any other coins? Is it purely just like Bitcoin market cap dominance and like having the most historical data to kind of pull from? Like of the coins, it's the least volatile of this volatile asset class.
Yeah, it's definitely the least volatile of everything that you can invest in crypto. For example, the realized volatility for Bitcoin right now is about 30%. Implied is about 40%.
Sure.
If I look at the implied volatility for ETH right now, it's 75%.
Yeah.
It's been lower, but it's also been a lot higher. At times, it can trade well above 100%. And that's because it can go up a lot more than it can go down. So you do have that asymmetry that's embedded in this. But it's definitely the least volatile. It's the biggest by market cap. It's the first. I think it's what people are most familiar with. It's very, very liquid. But for a lot of people that are just getting started, and you think about this as an investment, as a way to participate in this asset class, I think you start with Bitcoin.
Right.
to me, that makes sense. That's where I would point anybody if they're interested in it. I'm not going to say, oh, go check out X, Y, or Z token because I own some of it and I think maybe there's an opportunity for it to go up. It's more so, look, if you believe that there's real compelling reasons to invest in this space, in crypto, I would start with Bitcoin. Get comfortable with that. Have a small portfolio allocation. Let's see how it does. And then naturally, you kind of branch out and you learn more about some of the other assets.
Okay.
We should run the study, though, looking at a mix, right? It's not just 60-40. And then how does that shift if you add a little bit of Bitcoin? But looking at diversifying across crypto assets as well. And I think when you take it one step further, maybe gets back to kind of your earlier point around diversifying around strategies and different approaches, then it's, okay, I've got crypto as an allocation. Within crypto, what am I doing? Am I long Bitcoin? Am I generating yield in DeFi, trading options? There's a lot of different ways that you can slice it.
Yeah. I have one last question for you. So we kind of positioned this last couple of minutes around more or less a $100,000 portfolio. I love that we use that because it makes it easy to either like multiply or divide based on what your actual account size is. I'm still not in like a $100,000 account. So that being said, particularly for those like newer traders or smaller traders out there that are kind of in that Johnny account, something like $10,000, do you still feel like this 5% allocation still applies, or do the rules get a little bit more or less fluid?
I think it's always going to be fluid, right? There's no perfect kind of allocation here. We put the study together for illustrative purposes. When you have a smaller amount of capital, you're naturally going to have more concentrated positions. You have less capital to kind of spread out. And in some cases, when we talk options trading, right, the contracts are standardized. So you can do one, but it still is kind of big in terms of the overall notional size and allocation in your portfolio, what it makes up. And so I think if you have $10,000, you're getting into Bitcoin, maybe naturally you're going to have a little bit more than that 5%. Now, granted, you're going to see that $10,000 swing around by a lot more.
Sure.
But you probably want it to swing around by a lot more to the upside. You can only lose the $10,000.
Right.
Now you have $100 million, and you're probably not going to look at a 50% allocation to Bitcoin in that sort of institutional portfolio, or how you might manage that. So I think, again, naturally, you probably are skewed towards having a more concentrated position when you have a little bit less capital. But I still think, like, if you're looking for a framework, 5% or $500 of that portfolio could be a good place to start. Or maybe, depending on the volatility, less goes a little bit farther.
Yeah. Well, and the thing, I think, though, that no matter what, that I love is that, like, and I mean, we say this all the time, but just to make it abundantly clear, like, it's not like you have to put $500 if you're in a $10,000 account today in your portfolio. Like, you can buy $50 here, and $100 here, and $25 over here. Like, if you see a little bit of a pullback, so it's also nice to have like the ability to kind of layer into any type of core position. 5% in crypto being like one of those core positions. So I just wanted to like make sure that that was like obvious, as well as like, you don't have to go out right now and buy Bitcoin at 108. Like, you can kind of pick and choose your moments and times and cadences for that in a dollar amount.
Absolutely. I would dollar cost average into a position. That's what I do personally. It gives you maybe a better average price over time. It was $75,000 2 months ago. It's $110,000 here today. It could easily pull back below $100,000. That's as it's implied by the current spot price and implied volatility. So I think DCA is the way to go.
Good stuff.
Cool. Well, Katie, thank you as always for coming on and listening to me pontificate around portfolio allocation.
It's a good word.
And Bitcoin here. But I will be back on the show on Wednesday. Katie will be back with me next Monday. I guess if you have any questions for us, shoot us an email or go over and follow us at tastycrypto on X. But that's going to do it for our show. Victor Jones is up next with The Price of Truth. I'll be back on Wednesday. Until then, I'm Ryan.
I'm Katie.
Peace.
Peace.